Investing in a Roth IRA is so much fun and so much different than any of the other types of accounts because everything that grows within this account is going to be 100% tax-free. You could start with $100 and it could grow to $100,000, and all of that growth is never going to be taxed ever. You could have a huge dividend style portfolio within your Roth IRA and earn a $50,000 paycheck forever, totally tax-free, and you can give that cash flowing machine down to your children or to a charity when you pass. I'm an actual university professor and also a financial consultant who's worked with over 500 clients to this point. The ones that have set themselves up best and have millions of dollars in their portfolio definitely have the type of ETFs that I'm going to talk about today. The Roth is just so powerful, and so in this video I'm going to give you 5 ETFs that I'd definitely throw into a Roth IRA and buy and hold forever. In the comment section below, I'd love to hear your favorite ETF that you put in your Roth IRA and why. We have a bunch of beginners that like to watch these videos, and so it'd be great for them to see a library of what you guys have to say. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. The first fund that I'd consider for a Roth IRA is definitely one for those of you out there that just think this finance thing is way too complicated. All these ticker symbols and earnings reports and market volatility just seems crazy. It's kind of like when you get your car fixed, you may not know who's the absolute best at doing an oil change or changing your tires or fixing your transmission, but what you would like to do is just take it to a one-stop shop to get it all taken care of in one place. Well, that one-stop shop in the world of ETFs or index fund is one that takes all the guesswork out of it. It does all the work for you, and it starts out as a fund that has a bit more risk the further away that you are from retirement. It makes it so that if the stock market's going to go up, you're going to be able to gain with that and get the advantage of that, and then it decreases your risk as you get closer to retirement. It starts adding in more bonds for you and pulling you out of the stock market so that there's way less risk at the time that you want there to be less risk. It also just does all of this on its own and you don't have to do anything. This type of fund is called a target date fund. At Fidelity, these are called freedom funds. To check which one you'd want, you can go to their page and just say when you want to retire. Let's say you want to retire in 35 years. This one's called Freedom Fund 2060 because 35 years from now, it's 2060. The dark blue and light blue are the dominant holdings, meaning that this is almost all stocks, both US and international, with barely any bonds in the green there. As we get closer to your retirement in 2060, those blue funds decrease and the green and even yellow increase dramatically because those are your safe or cash equivalent and bond funds, so they're taking the risk out as you retire. At Vanguard, they have these types of funds, and then at Charles Schwab, they have them as well. You can click into them and see the actual holdings and percentages to know what you're investing in. I like these for those of you who don't want to be hands-on at all and who want to just pick one fund, set it and forget it, and know that you're going to be pretty safe. For those who want a bit more upside or at least just want a little bit more control over your portfolio, these next 4 are for you. One more thing about a target date fund though, most of you are probably already invested in this within your company's 401k. That's usually the default setting there. And so if you leave a company and you roll over that 401k into an IRA or a Roth IRA, it's likely going to be in that target date fund. You can choose to keep it in that, or you can move it into some of these other ETFs that I'm going to talk about in this video. And that's actually what I usually do outside of YouTube, is walk people through how to build out the best portfolio and specific strategy for them specifically, because everything is unique to you. In my private financial coaching sessions via Zoom, for about 1 hour, you can ask all your questions and we can go through all your investing accounts to review for one flat fee, and I don't take a percentage of your portfolio forever. Email me at ProfessorG.invest@gmail.com to set up a consultation soon. So this next one on the list is actually one of my favorite ones. Actually, if I could only hold one in total, it would probably be this one personally. At the foundation of everyone's portfolio, I hope you have exposure to either the S&P 500 or total US stock market, over the life of the stock market in general. This type of fund has been through it all with the Great Depression and recessions and the financial crisis and bubbles, but still it reigns victorious and just keeps growing. I have multiple videos on the S&P 500 and why it's the best, so watch those after this. But a couple of great ways to be able to invest in the S&P 500 would be through an ETF like VOO or SPLG or SPY, or at specific brokerages, they have great mutual funds that invest in it as well, like Fidelity has FXAIX, Schwab has SWPPX, and Vanguard has VFIAX. All are great and almost identical, and you definitely don't need multiple of them, just pick one, but check the fees and make sure everything is good there. They're all pretty much the same thing. This next category is for those of you that want to have a safer ETF, but also produces a nice cash flow in the form of a dividend. Especially within a Roth IRA, this should excite you. In a taxable brokerage account, dividends are cool, but every time that they pay that dividend, even if you're putting the dividend directly back into the fund, you still have to pay taxes on it each and every year. Within the Roth IRA, as that dividend's being dispersed and put either right back into the fund or even to just a cash account that you can withdraw, at retirement age, everything is tax-free. And so that is an absolute wealth hack to be able to just get this tax-free paycheck every single year, and you're never having to sell any of the principal. So if you have $1 million in there and it produces a $40,000 or $50,000 dividend every single year, you get that forever, and that $1 million will always just be there and you can pass that down. For this type of ETF, my favorite is SCHD, but one could also choose VYM, VIG, or DGRO as well. In a video I did a couple of weeks ago, this shows exactly how much dividends you could actually expect from investing in SCHD. I used their current numbers and average numbers over the last 15 years or so this is very exciting. Looking at this chart from Seeking Alpha, it shows the dividend growth rate in the far two columns. Most of those numbers each year are above 10%, and this 5-year average dividend compounded annual growth rate is 11.6%, which is outstanding. We're gonna need that number for what I'm gonna show you next. So on MarketBeat, there's a pretty awesome calculator to be able to show you not only what will this investment grow to, but also what can you expect your dividend income to be at that point. So let's say that we had about $10,000 invested into SCHD today, but each month we're going to put in $1,000, so that comes out to $12,000 annually. The dividend tax rate is 15% because on long-term capital gains it would be 15%, but if you're putting this in a Roth IRA or an IRA or any retirement account, you don't have to worry about that for now. The initial annual dividend yield, we'll put it at 4%, which is a little bit lower than where it's at today, and a little bit higher than it has been, but I do see SCHD being down for a little bit of time. The expected annual dividend amount increases from that chart that I just showed you before. Now what they had on there was 11.6%, but that's pretty high, so let's just bring it down to 8% to be conservative. And then the expected annual share price appreciation, when we look at SCHD on the actual website, since inception, the total return has been about 13% per year. But we have to remember that there was about a 4% dividend, so 13 minus 4 is about 9%, and so we can kind of expect it to grow at 8 or 9%. Let's just be conservative and say the share price will only grow by 8%. Let's say we have 20 years to invest, and let's look at what happens. So after 20 years, your ending balance will be at about $900,000, which is a total return over 250%. Your dividend at that point will be about $3,000 per month, almost $36,000 per year. The total dividend payments over that time was $225,000, and your yield on cost is 13.3%, which is just amazing and such a high growth. You can also see when you pull down here exactly what it would actually look like. So by year 10, if you wanted to look at that, you'd have about $200,000 in there. Your annual dividend would be about $8,000 per year, and so on and so forth. The next ETF is a Wildcard. But before that, I want to thank and introduce the sponsor of this video, Quadratic. One of my favorite tools to use to visualize your portfolio and to build out awesome charts without knowing complicated formulas is Quadratic. It requires no setup and works across your team out of the box. It runs right inside the browser so financial analysts, portfolio managers, and clients can easily collaborate in real time to ensure everyone has immediate access to the same up-to-date figures. You've seen me use Quadratic in a couple of my videos recently, and they just added this new feature that's incredible. It's called AI PDF Import, and it allows users to upload any PDF or multiple as context to your AI chat, and then you can simply ask Quadratic to pull in the data from it. It also works for images if you have a screenshot of data or even something like a math problem that can't be typed out. This has been big with my clients and their financial statements or quarterlies from the brokerage itself. You can connect directly to third-party APIs and databases to import real-time market data. By pulling in data from multiple sources, Quadratic empowers financial professionals to create dynamic dashboards, automate portfolio updates, and surface deeper market insights, all within one secure AI-enhanced spreadsheet. With the Pro package, you get 10 to 20 times higher AI limits, shared team workspace with unlimited sharing, and also priority support. Use code ProfessorG for a free month of Pro usage now. So like I said before, this next ETF is a Wildcard. It's for those of you who truly want to customize your portfolio a little bit. And you know yourself. Are you one who wants to be a bit more conservative and safe? Or do you want to be a bit more risky and hopefully get crazy high upside? If you want to be more safe, you're going to need something that's going to be a little bit closer to like cash or cash equivalents, maybe bonds, short-term bonds, some type of treasury, something of that nature. Usually for this ETF, people default to BND. Looking at the numbers for BND long-term and even lately, I don't love this one. Right now, my favorite, and actually the one that a lot of my clients have been using, is a short-term treasury, and it's called SGOV. The longer term, these numbers look much better, and it just seems so much more stable. We aren't looking for this one to go up very much because it produces a good little dividend yield. We just don't want it to go down, and BND is down 15% overall in the past 5 years, so that's why I don't prefer that one. For those of you that said that maybe you want to have just a little more risk in the portfolio, and for me, that's me as well, especially being a little bit younger. But for this category, you definitely want to find something that's maybe outside of the stock market, a different asset class, kind of like how bonds is outside of the stock market. And so by doing that, it diversifies the portfolio. For this one specifically, I would tell you that you need to educate yourself on everything in the world of Bitcoin and then jump in on a Bitcoin ETF like IBIT or FBTC. I like this one because it puts you in an asset class outside of the stock market and one that I believe can skyrocket in the coming years. If you want to go risky, but maybe not crazy risky and into the cryptocurrency or speculative space, but you do want a little bit higher of just technology or any type of specific sector, you can go into a fully technology ETF like VGT or a sector-specific one like SMH that's purely semiconductors for AI. Whichever way you choose on this, it should be either more risky or way less risky than the rest of your portfolio, because then you can either pull up the higher upside possibly or pull down for more safety based on your risk profile. Again, as I said before, my goal with all of this, and even why I built this channel, was to help people. I know that this stuff is incredibly nerve-wracking, especially if you're doing this on your own for the first time and forever. My goal is to build you a solid strategy and then to keep you on track, and I usually meet with my clients once a year to make sure that they stay on track and we can rebalance based on what's going on in the world. Email me at ProfessorG.invest@gmail.com and we can set up your first consultation. All right, the last one on this list, and actually I'm gonna give you guys a bonus one just for sticking around to the end, so stick around for that. This next one is all about growth. It's not as risky or crazy as the ones that I talked about earlier before, but it is definitely more aggressive than just your basic S&P 500 fund. For broad growth, I like VUG, QQQM, and SCHG. In this section, we want something that's going to be an ETF full of companies that can grow more than the rest of the market, but we want it to still be broad so it's not all technology or not all semiconductors or AI. That's why I like VUG, QQQM, and SCHG. Pick one of those and your portfolio will be solid. Looking at some of the numbers from SCHG, it's down about 9% so far this year to date, so it's on sale and it only costs $25.42 per share. For the past 10 years, on average, this fund returns almost 15% per year, which is just incredible. This fund is made up mostly of information technology, but has tons of communication services, consumer discretionary, healthcare, financials, and more, so it's pretty broad. All right, so now for the bonus. For those of you that stuck around to the end, this one's not actually an ETF, it's just a stock. But it's a stock that's run pretty much like an ETF that holds a bunch of different companies within the stock, and it's one that's been safer than the S&P 500 and has been beating the S&P 500 for quite some time now, and it's one of the only stocks that has done this consecutively. It's kind of a unicorn in the space. It's a company owned and run by one of the most famous investors in the world, Warren Buffett, and this one is called Berkshire Hathaway. And in this video, I go into it deeply as to what exactly is going on and why this is going to be a solid position in anyone's portfolio. Or watch this video to keep you going strong in investing. And remember to keep investing simplified.